Welcome to DIGI-FINANCE Hub channel. In this channel, I teach traders how to professionally analyze the Forex and crypto market for free so that you'll be consistently profitable like myself. I will take you from a beginner trader to an advanced trader. But before I start the teaching, please, if this is your first time of visiting my channel, you can do well to like, subscribe, and turn on the notification bell so that you will always be the first person to get my new videos. So today we are discussing the Forex terms. The terminologies used in the Forex market. Currency pair. A currency pair is a price quote of the exchange rate for two different currencies traded in the Forex market. The keyword here is the exchange rate. So when an order is placed for a currency pair, right? The first listed currency, or you can call it the base currency, is bought, while the second listed currency, which you can also call the quote currency, is sold. Example, Euro USD. So euro that you're seeing here now is the base currency, whereas this USD here now is the quote currency. So if you make an order to buy, it means you are buying euro and you're selling USD. So it is just an exchange rate. When they are paired together like this, all right, what it shows is that you can exchange the two of them. Do you understand? So that is what currency pair is basically all about. We have other currency pairs such as the major pairs. These are the USD pairs. They are the most traded pairs in the market. These are the examples of the USD pairs. The exotic pairs. These ones are not paired with USD and they do not have much liquidity in the market. These are the examples. These ones here now are the minor pairs. You can see them. Buying and selling. This means speculating on the upward and downward price movement of a currency pair with the hope of making profit. So let's use this AUD USD for example. If you analyze or you speculate that AUD is going to go up and you choose to buy it, if the price of AUD continues to go up, you will be in profit. But if the price of AUD declines, then you will lose. Buyers, they are also referred to as the bulls. There are people who believe that the currency price is going to rise and they will choose to buy. And if the price continues to rise, they will be making profit. But if the price declines, they will lose. So these are buyers. Sellers, they are also referred to as the bears. They are the people who believe that a currency pair is going to decline and they will choose to sell. And if the price continues to decline, they will be making profit. But if the price continues to rise, they will be losing. So both the buyers and the sellers are referred to as the market participants. All right. Bid price. Bid price is the price that a buyer is willing to buy or a buyer chooses to buy, while the ask price is the price that a seller is willing to sell. Some of us will see these things on the chart. We see bid, we see ask. So we may not really know what they mean exactly. So this is it today. So the bid price is the price that a buyer is willing to buy or chooses to buy, while the ask price is the price that a seller is willing to sell. Long. When traders are long or going long, it means that they are buying a currency. If you are the one, then you can say that you are longing the currency or you open a long position on the currency. So this long means the same thing with buy. When you're buying a currency, it means you are longing it. All right. Short. When traders are short or going short, it means that they are selling off a currency. So if you're the one, then you can say that you are shorting the currency or you open a short position on the currency. It also means the same thing with sell. Stop loss or SL. This is a pending order. So it is an order you can set at a particular price after buying or selling in order to limit your potential loss on a trade. Stop loss order automatically triggers immediately it gets to the particular price you set to close the trade with some bearable loss. Okay, so if you set stop loss order, when it gets to that particular price you set it, the market will automatically close for you. Either your phone is on or your laptop is on or you have data or not, it will close automatically with some bearable loss. So anytime you open a position, either long or short, make sure you put your stop loss order, because if you do not set your stop loss order, it means that you are risking all your capital in the market. Okay, So it is very, very dangerous to enter or open a position either short or long without stop loss. Take that. It is very, very important. Take profit or TP. This is also a pending order. Okay. A take profit order is a type of order that instructs a broker to close a position once the market reaches a specified profit level. This order type allows traders to lock in gains automatically without having to constantly monitor their open positions. So it is important you set the take profit level because sometimes the market can spike to that particular place of your take profit and it will reverse. So which means if you did not set your take profit, if the market gets there and reverse, it will clear all your profits and begin to give you loss. So you can set these orders in the market so that they will automatically work for you when you are not watching your positions. That is the importance of stop loss and take profit. They are very, very important. Candlestick. The candlestick is a kind of price chart which is used when doing technical analysis to show the low, high, open, and closing price of a currency pair. It is the market price that creates the candlesticks. The candlesticks can represent the buyers and sellers in the market. The commonly used color for the sellers is red, while any other color can represent the buyers. So what this means is that each time you are doing analysis on the chart, the candlesticks you see on those charts is representing the buyers and the sellers. When you see red color candlestick coming out, then it means that the sellers are already in the market. Okay. So, and if you see another color showing up in the chart, then it means that the buyers are in the market. The market price. The market price is the current price at which a currency pair can be bought or sold. It is the market price that creates the candlesticks. So this is where you will understand it. If buyers are in the market, their candlestick goes up. So it is creating the candle upwards. Okay. So and if the sellers are in the market, their candlestick goes down. So it will be creating a decline price. So the price will be going down. That is how you will know that it is the price, the market price that creates the candlesticks. Chart. The chart is the graphical representation of price activities of buyers and sellers on a particular currency pair. It is the candlesticks that make up the chart. Okay, so just like I told you that the price, the market price creates the candlesticks. Okay, so here now it is the candlesticks that make up the chart, and that chart you see is the graphical representation of the price activities of buyers and sellers on a particular currency pair. When buyers and sellers are in the market trading, the candlesticks are being created because it is price that they are using to trade. So the price will be building the candlesticks, and the candlesticks all put together make up the chart itself. Okay, so that is how these things are connected one to another. Time frame. This refers to the amount of time buyers can control the market price before the sellers take over the market price, or vice versa. The time frame is what determines the lifespan of a candlestick. For instance, if a candlestick opened or started on 1 minute time frame, it will last for just that 1 minute and another one will open. That is why you can see different cuts of candlesticks on the chart. It is the time frame that controls the lifespan. Each candlestick lasted for the time frame you opened. If you go to the chart, you will see time frame 1 minute, 2 minutes, 1 hour, 1 month, one week. You understand? So if you open any chart on a time frame, all the candlesticks you see on that time frame lasted for that time frame. If you open a chart on 4 hours, it means that all the candlesticks, both the smallest one, lasted for 4 hours. When I finish explaining the forex terms or the trading terms today, you will no longer have issues with them anymore. So, but before then, I'll give you 5 seconds to subscribe and like just to appreciate this free information I give. So let's start. 5, 4, 3, 2, 1. Just click it, is down there. Thanks for appreciating. Let's continue. Trend. This simply means the direction the price of a currency pair moves towards over a particular period of time. So this is to say that if buyers are in the market for a long period of time, the price will continually go up. And when the sellers do the same, the price will continually go down. Okay, so we shall look into this trend deeply in my next video. Pullback, correction, or retracement. These three things are the same, and this means a temporary reversal on the prevailing trend. I just finished explaining the trend now. So if trend is going up and all of a sudden the market starts coming down, that is a pullback. Or it was going down and all of a sudden it starts going up, that is also a pullback. It will not last and then it will continue on the original trend. Trend line. This is a line you can draw on the chart which shows the trend or the prevailing direction of the market price. So this is the line that you can use to keep the trend on track, to know when it will break it and change to another trend. This trend line is a very powerful tool when doing technical analysis. So we will take it higher. I will teach you more about trend line in my other videos. Resistance. This is that level where the price reaches when the buyers are taking the price up and it becomes difficult to go higher anymore. This looks like when the price met a ceiling and the force from the ceiling may possibly send it down. So do you get this now? You know, I told you that the buyers, when they're in the market, they keep taking the price upwards. So the candlesticks will be creating upwards, will be going upwards. So as they are taking the price up, the candlesticks are building up. Okay, it gets to a level where it is difficult for the price to keep going higher. Okay, so that level is the resistance level. It's like when you are in your house, the ceiling of your house is something you can use as an example. Okay, so it's possible that that level of resistance can send the price down. That means the power of the buyers finished at that point. Okay, but if the power of the buyers are still strong, they could break through that level of resistance. Support. This is that level where the price can fall to when the sellers are taking the price down and it becomes difficult to fall further. This one now looks like the price made a floor and the force from the floor may possibly send the price up. So I want you to understand something here carefully. When I was talking about the resistance, I mentioned buyers. So the level where the buyers took the price to and the price could not go higher anymore is the resistance level. So from there, sellers will take over the market because they've seen that the power of the buyers has finished. So they will take over the market and start bringing the price down. So as they are bringing the price down, it will get to a level where they can no longer take the price down anymore. So that level is the support level. So it's like the price is finding a rest at that level. Okay. So what I want you to know is that when you're talking about buyers taking the price up, resistance is what the price will meet. And when you're talking about sellers bringing the price down, support is where the price will meet. Don't forget these things, okay? Because as we continue in the training, I will bring up this in the higher class. So if I mention it there, you will be able to understand it if you understood it here now. Consolidation. This is when buyers and sellers meet on the same time frame to drag the market price to know which party will take over the market price. Therefore, this will make the market price to be neither rising or falling, thereby causing confusion or a range in the market. This is when we refer to the market as being confused, and it will confuse every other trader. Therefore, at this point, you that is trading in the market, I will advise you stay out. You don't trade when consolidation is happening in the market because you don't know either the market is going up that you need to buy or the market is going down that you need to sell. The market goes up, goes down, goes up, goes down at the same time. You understand? So you need to stay out of the market at this point in time. Stay out and wait. Let the breakout of that range level happen before you follow the market again. Wow. Thank you for staying to the end of this video. We shall meet in my next information packed video which will drop very soon, which will take you a step further in your journey to becoming a good and professional forex trader, which I will make you very soon. So if you have not liked and subscribed, you can do that now so that you will not miss out when the next video drops. Until then, friends, stay safe and bye for now.